My name is Erik Van Horn. I bought my first franchise in my 20s, and since then, I've owned 6 brands with 25 stores in 8 states. I've also helped 1,000 people find the right franchise for them. People like us who are not cut out for the 9-to-5 and like to work smarter, not harder. How do we find the right franchise, buy it, grow it, sell it, and how do we do it in a way to own the business without it owning us? Those are the questions, and I'm on a mission to give you the answers. Welcome to Franchise Secrets. Welcome to the Franchise Secrets podcast with your host, Erik Van Horn, here with today's guest, John Warrillow. I was on John's podcast a while back, a wildly successful podcast, and I'm going to let him tell you about it. But he's written 3 books. I'm going to talk really about 2 of them today, Built to Sell and The Art of Selling Your Business. I get this question so often from franchisees, like, how do I build a business to sell? And then this newest book will really help you understand the art of selling your business. But John's a big deal. I'm glad you're on my podcast. Thanks for coming.
Hey man, you're a big deal. It's great to be here. Thank you.
I put a post out on social about your book, and I got some private messages, and then a buddy of mine said, "Hey, can I get John on my podcast?" So it really was an honor to be on your podcast, and I had a blast doing it. And then you put out the title, the bad boy of something. So
yeah, something like that. The badass sale of, I can't remember what I said, but yeah.
Well, I want to talk today about selling your business. The question that I get from a lot of franchisees, John, is how do I build my franchise or my business to make it sellable, to sell it at some point? And a lot of people, once they're in it, they start thinking about that. Most of the time, people start thinking about it too late. So I know, like, you're the expert in all things selling and building businesses and selling businesses. So love to know your perspective and where you want to start with this. Or give people some background on yourself as well.
Yeah, I mean, briefly, I've been involved in a few businesses that I've started. I tried to basically put together the key lessons in a book called Built to Sell, which was written in 2011. And I run a company called the Value Builder System, where we help entrepreneurs improve the value of their business. So that's me in a nutshell. I think one of the things that service businesses in particular struggle with when it comes to building a valuable business, a transferable business, is effectively that the company tends to be dependent on them. Now, franchises have usually a killer advantage because they've built systems, right? They've got the processes that help them run without the owner. And that's one of the core ingredients. So on that front, they've got a leg up because they've got those systems in place that enable other people to do some of the work.
If they choose to do that, right? I mean, they can even you can have all the systems and processes, but if the owner does not take a step back and rely on those systems and processes, and they're always doing the work themselves, then that doesn't make for a sellable business, or makes it for a lower multiple. What would you say?
All of the above. So in some cases, an acquirer will not buy a business that's deeply dependent on its owner. In the event that they did buy it, they would use something called an earnout, or in a case of a private equity deal, they force you to roll some equity. So an earnout is effectively where you sign up for a set of goals in the future that you are not totally in control of, because your earnings will be usually reported by your acquirer. And they can be like hell for a lot of entrepreneurs, because as entrepreneurs, we're kind of wired for freedom. Earnouts are like, you got to do it in this specific way. So not always great. The second way that acquirers tend to buy businesses, in particular where the owner is central, is in a situation where the private equity group asks you to stay on and carry some of your equity forward. So a deal would be similar to, 60% of your equity we're going to buy, 40% we're going to ask you to roll into a new entity. And that sounds good on surface. In some cases, I get to keep running my company. I just interviewed a guy called Ryan Moran, who had a similar situation like that, where he sold 60% of his business, but it rolled 40% of his equity. And the 40% went to zero because the private equity group mismanaged the business after he sold it. So it's not ideal because you're not in control anymore. And so the secret is, of course, to build it so that it's not dependent on you. And that allows you to a large extent, avoid these different sort of structures.
So sometimes how would you avoid that? How would you do due diligence on that private equity company to ensure, like, if that roll forward, and that 40% equity was in that new company, where could that be a really sweetheart deal? Because I know some that have done that, and if it's a solid company and they have a plan and they execute on the plan like they think they are, then they've just double dipped and they did really well.
Yeah, and you're absolutely right. There's lots of examples where they do end up working out really well for the entrepreneur. I interviewed Lee Richter, who built a cool business doing alternative medicine for animals in the veterinary space. She carried, I want to say, 30% of her equity through and doubled her money in that formula, where the private equity group went on to resell her tranche of equity. So it can work out really, really well. The challenge, of course, is that once you're a minority shareholder, you are just that. You are a minority shareholder, and therefore you're almost at the beck and call or the mercy of your acquirer. So I don't like, personally, the idea of selling a majority share in a business that I fully control the outcome of, and basically trading that for a minority stake in a business I no longer control. So one piece of advice is, look, negotiate for as much cash as you can up front. It's okay to roll a little bit of equity and make sure you're being a team player and you're shoulder to shoulder with the private equity group. But if they ask for 40, maybe it's 10 or 20 that you roll would be a much more comfortable place, I think, in a lot of cases. The other thing you mentioned about due diligence, like, how do you check out a private equity group? Well, obviously, if you have the opportunity to talk to other entrepreneurs that have sold their company to that group, I think that's going to be good. Number two, practically find out how much leverage they're going to use. So the reason private equity companies run into trouble usually is because they are using a lot of leverage, meaning the more leverage they use, the more difficult it is for the new entity to pay back the debt. And so you want to make sure that your private equity up is not too levered up. You're not going to lever up the new entity to the extent that it makes it difficult to pay back that loan in a small downturn or correction. And then I think qualitatively, what you're looking for is a private equity group where you're meeting with them and you're like, man, these guys or gals get it. They're smart. They're adding value. I would like to be their partners. You don't want dumb money. Like, dumb money is where you've got a private equity group who's just sloshing around in so much cash that they're like, yeah, we could finance your business, but they have no plans of how they're going to add value. They have no plans for how they're going to grow it. That's a recipe for disaster, because you're now a minority shareholder in a business that's owned by people who don't know what they're doing. So I'd be really qualitatively evaluating, like, did these people get my industry? Do they know how value is created?
And when you're in the middle of it, you see the dollar signs. They have all the dollar signs. They're giving you a big purchase price, and yet they don't have like a value add that they're going to do as a private equity company. Then you just see the purchase price and you're only getting 60% and you're leaving 40% on the table. And if it's just about money, and money can be cheap at different times. So I love that advice. And I need to go check out your podcast that you did with Lee. She and I are part of the same mastermind. And so we got to know each other a bit, and she was probably in Hawaii when you were doing that.
That's right. She was in Hawaii, actually. Yeah, I was teasing her because she goes a mile a minute. She's a fantastic entrepreneur, and so she had a double dip, or a second bite of the apple, as they say in M&A parlance or private equity parlance. But and then in case it goes the other way. So Ryan Moran, so I think it was about a $19 million exit. He owned half the business, rolled 40% of his equity, so you can do the math on that, into a new entity. And part of the thing was he wanted out. He didn't want to stick around as the manager of the business after he sold. He wanted to let someone else run it. The private equity group brought in a new manager for the business, but effectively didn't know, in Ryan's view, what they were doing. And the business soon faltered under new leadership, and it went to zero.
This is fascinating because there's a lot of people that are in franchising right now. And I was just in a meeting with my mastermind that I host for franchisees, and we were talking about that. And we're seeing more private equity come into franchising as a franchisee. There's a lot of private equity that's on the franchisor side of things, but as franchisees, we're starting to see more of it in different concepts like Everbowl. Jeff Fenster on the podcast, the founder of that. Crumble Cookies has private equity franchisees, and a lot in the food space and fitness, like with Orange Theory and different ones. But there's franchisees out there that are, maybe they bought 1 or 2 units, or, there's just a business owner. They're small. They're small business, and they're thinking to grow it and to sell it at some point. And they don't even know where to start. Like, how do I build a business that's sellable? Like when is it too soon to be thinking about building a business that's sellable? If you're just in the mindset, John, of like, you're just in the cash flow mindset and they just want to build it. But like, when should they start thinking bigger?
Yeah, look, I think from the very beginning, if you can be thinking of your business as an adolescent that you want to basically nurture out of the house. So like, I know you're a parent, and I think this is a really good analogy for anybody who's a parent. As a parent, some of us want to send our kids to some fancy school or they play on some fancy team. At the end of the day, most of us, however, I think would be very happy if our kids grew up to be happy, well-adjusted people who could kind of go about their business in the world without, much problems. And we'd be super satisfied as parents if that were the case. I think for a lot of business owners, we would be well served to think of our job as the founder of our business as the parent of our business. The idea that really the goal from every decision you make should not be to maximize profitability, should not be to maximize revenue. It should be to make sure that your company can succeed without you. And that's a head scratcher for a lot of people because we're socialized, I think, as entrepreneurs. It's like the profit and loss statement. That's my report card. I'm going for 5 million. I'm going for 10 million. I'm going for $1 million of EBITDA. Like that's how we are trained to think, right? And that's how we're celebrated on the cover of Inc. magazine, top 5,000 businesses. It's all about growth. And I think that can be a fool's errand. I interviewed a guy recently, a guy named Rob Walling, who built a little company called Drip, which is an email marketing solution. He built it up to $2 million of annual revenue. So like, not a huge company, like a couple of $1 million of annual recurring revenue. Lots of your listeners would certainly hit that threshold. Compare him to another guy I interviewed who had a direct marketing business. I won't share the name of it because I think he preferred that I don't, but it was a $15 million business. They were drop shipping a product and they were generating lots of demand on a transaction model. Well, the $15 million business sold for 25% of annual revenue. What is that? 3.5 or something like that.
Mm-hmm.
Rob Walling's company, with all of $2 million of annual recurring revenue, was entertaining offers between 9 and 12 times top line revenue. That's my way of saying it's not
top line revenue.
Top line. So again, $2 million company selling for much more than the $15 million company that's been chasing revenue. And so look, I don't think chasing revenue is the right answer. If it's undermining the value of your company because the revenue you're taking on is more and more dependent on you personally, it's kind of like just running on a hamster wheel. Like we could all have cash flow businesses and that's fine. But if your goal is to build something that you could ultimately sell, every decision is like the parent with the 16-year-old in the basement trying to think about how am I going to get this kid out of the house? And it takes a lot of the pressure off, by the way, needing to hit some top line number, when the goal is really just to nurture this baby into the universe. It just changes the entire way you think about the job of running a company.
How do you know when you've kind of made that mental shift? Like, is it something that you start doing? Is it a hire that you make? Like, how do you know like that you've actually started thinking about, building it the right way?
When you stop dealing with customers is probably the most obvious or overt decision you've got to make, because customers, if given the chance, everyone wants Erik, right?
Mm-hmm.
Given the chance, you're going to say, oh, I know you have the thing, but I just want your advice. I know you've got a mastermind, but I just want you to respond to my email. They all want you, right? And so at some point you've got to say, no, I'm not going to be your personal consultant, your personal advisor or whatever. I'm going to build a structure, build a team, build some IP, build something that puts a barrier between me and the customer. And that takes a lot of courage. But once you do it, I think it then is the flip that switches, and you're like, okay, now I see that I'm building something that doesn't necessarily rely on me personally. And as long as you entertain that one customer who has that special favor, that special customization that they've asked for, you're just running on a hamster wheel. It can be great cash business. And look, there's lots of businesses that are dependent on their owner that are wildly profitable. I mean, Tim Ferriss comes to mind. He's built an incredible business, like beyond any imagination, yet it's not a sellable company, right? And so that's okay. That's his decision, and that's the decision he's making. Gary Vaynerchuk is another example of a tremendously successful entrepreneur building VaynerMedia, et cetera. Arguably how much value the company has without Gary. And so those are the things that we want to make sure we're not making the wrong decisions there, that you're building a company as opposed to just a personal brand. And in a world where personal brands are very sexy right now, it can be a bit of a head scratcher for a lot of people, right? Like, I thought I needed to build a personal brand. You do to build a profitable business, or you can to build a profitable business. But the more your business depends on your personal brand, the less it can be valuable to anybody else.
Now, that's so true. Roland Frazier talks about that quite a bit. I don't know if you know Roland. I'm sure you do.
Just exchanged emails with him about 10 minutes ago.
But he talks about that a lot, and what he did coming into digital marketer and how he kind of rewired some of the way that they do things, and even the way that they label their businesses from a valuation standpoint really changed things for them. But I've learned a ton from Roland. I was just texting him the other day about some ideas that I had, and he helped me. So he's just a brilliant business mind. But one of the things that he talks about and really got me thinking is about the way that businesses are valued. And there's, like, I can't remember what he had, some type of valuation index. What do you think about, how do you go about, if you were to start a business, here's a better way to ask the question. If you were to start a business and you wanted cash flow, but exit value, higher multiple, like, where do you go about to even see what kind of businesses typically trade for a higher multiple than others?
Yeah, it's a great question. So, of course, a business is only worth what someone's willing to pay for it, right? So that's a cliched expression, but it basically is important, because there's going to be strategic value in your company that may go well beyond what it's worth on paper. There are generally three types of ways to value a company. So you've got basically your asset value, right? The assets you have in the company, the desks, the computers, whatever, usually renders a very low valuation. Most people want to be paid for the goodwill in their company, which is accountant speak for what your company is worth minus your assets. That's your goodwill in accountant terminology. And so comparables are where a lot of people would go to look for. So a comparable is something, a business like yours in the public domain that you learn about that's sold. So Built to Sell Radio is a good place to do that. You get a lot of different stories. So that's one. The challenge with using comparables is oftentimes it leads people to look at public market comparables. So you've got a software company as an example, and you're like, okay, well, Salesforce.com is trading at 12 times revenue. So, well, my software company should trade at 12 times revenue. Or, that's a bad example, but that's the kind of thing that you run into. The problem with using comparables is it's usually an apples to bananas comparison. Usually public company multiples are much, much, much higher than private companies. So it can be hard. The third way to look at it is what's called discounted cash flow, DCF calculation, which you could Google, but effectively you're basically taking how much money the business is expected to make in the future and discounting that to today's dollars. That's a way that you can place a value on a company, and a lot of buyers do that. And I think that the answer to your question is, how would you go about valuing is probably using all three and triangulating around what does that look like, and you can get some of those multiples publicly. But again, when you're looking at comparables, it's almost always much larger businesses. So you're going to want to probably use DCF, which discounted cash flow, which basically looks at your profitability and projects it out in the future.
And some of the things like with discounted cash flow, because that's what we did. That's one of the models that we used when we were selling Sola. I think from a brick and mortar standpoint, any advice on like building it to sell? Because first thing that comes to my mind are the leases. If you have a lease that ends in 3 years, and then the buyer is wanting to do a discounted cash flow where you are, and how do you, there's something that is changing in 3 years that's not predictable. So that's one of the reasons I like to have kind of caps built into leases that I sign. I'm trying not to sign too many more leases, to be honest.
Yeah.
I'm definitely moving more into the home services space than I am brick and mortar. But, brick and mortar's been my world for 19 years. But that's when people are signing their lease for the first time, they're not thinking exit. And that's why it's nice and early on to at least pre-negotiate some things to allow you to have some extensions or options on that lease with some caps on it. Because other than that, like when you do a discounted cash flow and that lease is up in 3 years and it's up for renewal, and then it's all renegotiation. And let's say we didn't have COVID and we were in a hot market, that would impact that discounted cash flow, wouldn't it? What does the buyer look? How does a buyer look at that?
Yeah, it depends, I think, on the importance of location in your model. So clearly for most franchise concepts, the location is critical, right? And it makes a huge difference in terms of, walk-in traffic and so forth. So in that case, yeah, being able to demonstrate that you've got a lease, that it has a certain cap in terms of its increase, et cetera, is going to be important to an acquirer, that's going to lock in a high degree of confidence. In the other way, it actually may act as a detriment. If you're in a franchise concept that does not require proximity, is not a franchise, retail franchise, and you have some long lease, it could be viewed as a potential liability, because a lot of businesses are moving virtual, and the idea that they're somehow obligated to pay could be a problem. The other thing that you didn't own any of the underlying real estate under Sola.
Correct. That's correct.
Yeah. So look, I think a lot of entrepreneurs think, I'm going to build equity by buying the building and then lease it back to myself as the primary tenant. And that could be an interesting way to go, certainly to build transferable equity. There's always an underlying value to real estate, even in a down market. The challenge, of course, is that when an acquirer looks at a business, most professional acquirers are pure play. They're in a specific industry. They don't want to own a bunch of real estate outside of what they know how to operate. And so they'll look at that and go, I don't know what to do with that. So they'll probably have you carve out your real estate holdings, if you haven't already, for tax and liability purposes, into a separate entity. And then it really becomes more of a personal financial planning decision. Like, do you want to own a commercial real estate building? Great. Well, then sure, lease it back to yourself. But if that's not really what you want to do from a personal finance perspective, is own a piece of commercial real estate, then I wouldn't do it just to build equity into your business. I think there's a lot easier ways to build transferable equity than just to buy real estate, which may tie you down, ties up a lot of capital, and may not add a lot of value to your company.
When cash flow starts to change, and again, in a normal environment, let's say we're not dealing with the pandemic. In a normal environment, I've got a business and I see things changing, whether the industry is changing, my personal situation's changing, employees, they're going to be leaving, some key employees, or something that I know is going to cause my 5 years of historical increases in cash flow and just a healthy business that is looking healthy and staying, on that track. And I project it to start going down. What happens to like a discounted cash flow when you start to, if you use that from a valuation model, in a business that's starting to go downhill versus like still going strong? Yeah.
I mean, look, it's not good. Acquirers are trying to buy the future, right? That's they're all about the future. And so from a discounted cash flow perspective, again, Google it if you're interested in this stuff. I encourage your listeners to
Dude,
Google.
you don't have one of those on your link on your website?
No, man, because it's a bit academic and a bit technical, but effectively you're basically looking at the future stream of profit and you're discounting it back. The problem with that is if your profit is going down, that's going to be a huge deterrent for anyone looking at your company. You want to be selling on the upswing as opposed to the crest. And I think a lot of entrepreneurs, we make the mistake of wanting to time our exit. We're like, we're going to sell when my business is right at the peak, the economy's booming, interest rates are low, and I'm just going to kind of run off into the sunset. And nobody is that good, by the way. Nobody is that good at predicting the future. And more often than not, what you end up doing is what you're describing, which is riding it over the top. I'm reminded of a guy had a podcast just after you, Erik, was a guy named Rand Fishkin. Do you know Rand?
I don't.
Okay.
I don't think I do.
Rand wrote a beautiful book. It's required reading for any entrepreneur. It's called Lost and Founder. It's a really good book. But Rand built a business called SEO Moz, built it up to $5 million of recurring revenue. And he decided he was going to sell it. And he got approached, by a guy named Brian Halligan, who runs HubSpot, was a co-founder of HubSpot. And Halligan said, look, I'm going to give you, it's a $5 million business. I want to give you $25 million. So it's 5 times revenue, most of which is cash, some HubSpot stock. And, most of us would be given 5 times revenue, would be like, hello, where do I sign?
Yes.
But in actual fact, Rand said, no, I've been told my business is maybe worth 4 times top line, and I expect to go from 5 to 10 this year. So why don't we make it 40? The Halligan goes, I'm not paying for the future. I'm paying for today. I'll pay you 25. And Fishkin says, no, I'm not going to do it. And so he doesn't take Halligan's offer. He goes and raises venture capital, and he invested in a bunch of different businesses, business lines, if you will, most of which struggle. Rand goes through a period of clinical depression. He's removed from the board, moved as the CEO from the venture capital firm. And I asked him around the time that I interviewed him, I said, what's your share in Moz worth these days? And he said, it's probably not worth anything. And I said, what are you talking about? And he said, well, with venture capitalists, when they invest with preferred shares. They prefer to guarantee return before I get anything. And because of the length of time they've held it, I probably won't get anything. And I said, what would that offer from Halligan be worth these days? And he said, well, based on the appreciation of HubSpot stock, it would be worth close to $200 million.
No.
So look, it's a very, Rand tells the story with eloquence and grace and humility, and it's definitely worth hearing him do that. But it's just a cautionary tale, and it goes back to your point. The biggest mistake I think we make as entrepreneurs is we ride it over the top. We try to time, we get too cute. We try to time our exit to a point where you can start to see things slowing, but the acquirer is going to see it as well. And that's when things go horribly wrong. So,
and you think about it, if you do try to ride it to the top, there's such a peak right there. And then it's not like it starts to, you're not going to get a little bit higher or lower valuation. Everything changes once it starts going downhill. Like everything changes.
Yeah. And you know what acquirers look for a lot? I'm not sure if you saw this at all in your company, but they look at your gross margin. Why gross margin? So gross margin is one of those silly little statistics that's like buried in your P&L. It's like nobody really cares about it. It's like this boring. Acquirers, when they sign a letter of intent, they get access to your books generally, and they start to go through it. And if they see your gross margins start to deteriorate over time, the conclusion they draw is that you've ridden it over the top, because you may be showing growth on the top line, but they'll draw the conclusion that in order to fund the growth on the top line, you're effectively buying business. You're going out and basically dropping your pants, dropping your price, and going out and faking your top line revenue growth. And as the gross margin starts to compress, they're going to say, forget it. The best days of this company are behind it. They're no longer differentiated. They don't have a moat. We're out. It's one of the big reasons that deals fall apart between letter of intent and final share purchase agreement, is because when the acquirer gets in underneath the covers and starts to look at your financials, they see gross margin erosion.
I didn't know that. And as I look at it, I think we were fine with our gross margin. It wasn't starting to erode. It was fine. But I can see that as you say that and explain it, it makes perfect sense. But I didn't know that. What are some examples? What are some, like, what would you consider gross margin? Like in different businesses, just for the listeners, a simple,
yeah, for sure.
This is gross margin. This is where typically it starts to deteriorate.
Yeah. So gross margin is effectively so you take your top line revenue and then your cost of goods sold. So the raw material of things that you buy, and you're left with, things that you sell, and you're left with your gross margin. And your gross margin is let's say you sell a widget for $100, and you need to buy $20 of inputs to make that widget. Your gross margin in that case would be $80, and your gross margin percentage would be, in this case, 20 as a percentage of 100, or 80. Your profitability would be 80%. That's your gross margin. Now, it's less important. Different industries have different gross margins. Like if you're in a manufacturing business or if you're in a distribution business, your gross margin can be as little as 10 or 15%. The actual number or percentage is less important than the trajectory of the number. So if you're in a business where you have a gross margin of, let's say, 20%, so it's a fairly low margin business, and you've been able to get that from 20 to 21 to 22 over the last 3 years, well, that's a really good sign. That means you're starting to differentiate your offering. You're getting more pricing authority. If you've gone from 22 to 21 to 20 and you're looking at 19 now, that's a problem. And so it's less important, like, where you are as a percentage, because every business and every industry is different. It's more the trajectory of those lines that's important.
What's COVID done to everything? I've got people. So an example, I have friends that are in the fitness world, and some of them are doing fine and some of them are not doing so fine. And let's just get real specific here. There's a great brand called Orange Theory Fitness. They used to make a lot of money as a whole when the economy was, when like we lived a normal life back then. Sure. They were doing, I was talking to somebody today, his average store locations were doing $300,000 EBITDA. And they're not doing that today. Some of them are doing, are open and they're making money, and some of them are completely shut down. So the question around here is, from a buyer standpoint and a seller standpoint, when should a Orange Theory franchisee or a fitness franchisee that's used to making 300, should they be in, like, what goes in their mindset if I'm in expansion mode, buying out others right now, or if I am a seller? Let's just talk through that, use that as an example or as a scenario for somebody that's wanting to buy or sell an Orange Theory.
Yeah, sure. So look, COVID for some industries, and fitness is a great example of this. It has been devastating, absolutely devastating for those businesses. Here we are recording this in January 2021, and in many parts of the country, you can't go to the gym, right? So it's very, very problematic. As a seller, you're going to want to make the case that COVID is a once in a generation, once in 100-year black swan, and that we should look at our 2018 and 2019 numbers in order to look at the true accuracy of this business. So in your case, if they've been making 300 and negative 300, let's say, you're going to make the case that we've got to eliminate this 2020 out of our financials because it was a black swan. From a buyer's perspective, they're going to say, oh, no. The negative 300 is your most recent, financial year, that's what we're going to place your value on. And I think what you can try to do as a seller is try to come up with a weighted average, some sort of average that says that on an average over the last 3 years, this has been our profitability. And that takes into consideration the difficult year of 2020. That's an approach you could take as a seller. Clearly, as a buyer, you're going to want to take 2020 numbers, but I think as a seller, you're not. Remember also that as difficult as this year has been for a lot of businesses, there is just a tremendous amount of free money that is out there that private equity companies are using. They're like drunken sailors being given a bottle of whiskey. I mean, it's just crazy how much private equity is out there, how much cash they have, because again, private equity groups, as we spoke about earlier, they're completely fueled by debt. And when debt is as easy and cheap as it is right now, they can buy businesses. And so they're buying businesses. Some are buying distressed companies. And I wouldn't be surprised if some are buying fitness industry, because they're seeing an opportunity to buy what is usually a good business that's had a once in a generation sort of black swan event occur. So it may actually be a really good time, because one of the things that I have found about private equity groups is they tend to be very much like sheep. They are followers, right? So they generally will come up with investment criteria, and like once, they'll say, I want a business, I want a fitness business in a protected niche that's in a growing market with management that's willing to stay on. And that'll be their investment criteria. Guess what? Those 4 things are the same investment criteria of 50 different private equity groups. And so if you're attractive to one or get an unsolicited offer from one, the chances are there's another 49 out there that will want to buy your business is high, which allows you to create competitive tension and allows you to kind of make the case that let's move past 2020. Let's look to the future. Let's imagine what this business could be with new ownership, et cetera. So I think finding multiple buyers is important, in particular in a distressed sort of environment.
What about if someone was wanting to buy, like I'm the buyer and I'm wanting to purchase some of this stuff, and it's hard to come up with a price because, the buyer and seller are at complete opposite ends, but both want to get a deal done. And let's say there is a deal that's going to get done. What does that deal look like? Is it an earnout? Is the price adjusted somewhat based on what actually happens in 2021 or 2022?
Yeah, look, again, I've spent the better part of my career helping entrepreneurs get more value for their company, not how to buy cheap. Like we're all about the opposite.
But let's say like a deal needs to get done and it's going to get done.
Yeah, for sure. I mean, I think you can think about structures where there is an earnout component. I'm not a big fan of earnouts being tied to profitability, because I think it drives the wrong behavior. If you're trying to buy a business and you're trying to integrate it with other businesses, at the end of the day, what you want is to integrate. You want the synergies to be monetized. And what an earnout does is put one owner against another company in essence, because they want to create maximum profitability, and that may not be what the buyer is looking to do with the business. And so I think for that reason, I would love to see an earnout, if I were advising a seller, tied more to things that you could control, right? Like, I mean, your tenure in the business, you're willing to stay on, it would be great. Very rarely is that possible in the case of an acquirer, but more so thinking about your top line revenue. I remember I interviewed a guy named Rod Drury who started Xero. Do you know Xero? The accounting package. They're like, they're a SaaS-based accounting package that kind of compete with Intuit. Anyways, unicorn, billion-dollar company. Rod Drury got the money to start Xero by selling another company called Aftermail. They did archiving basically email after Sarbanes-Oxley came out. This is 20 years ago now. And Drury sells the company. And the New Zealand, where he's from, the newspapers reported the headline number is $35 million. In actual fact, when I got underneath it, it was actually $15 million up front. $20 million in an earnout. Now, still spectacular numbers. He was a young guy at the time, right? And so what does a young guy do when he gets offered $15 million of cash? Like, you have a party, you're like, it's a life-changing amount of money, right?
Yeah.
And so time went on, and Drury kind of got back to business and started finding his way in his acquisition, kept trying to figure out how he would hit his earnout. But by that time, so much time had gone by that he wasn't able to hit his first gate in the earnout, right? Because earnouts generally have gates. So you got to hit the first gate in order to free up the budget to hit the second gate. It's like downhill ski racing. You miss a gate, you can never recover. And in Drury's case, he missed the first gate because it just took him too long to kind of integrate into the new company. And 6 or 8 months after selling Aftermail, he walked away with nothing from his earnout. And that's a very common story, right? Because earnouts are at risk. And again, no one needs to have any tag days for Drury. He built a wildly successful company, and it all worked out just fine for him. But the moral of the story is an earnout is often used when a buyer and a seller can't come to terms. And if, again, as a seller, I think what you want to do is not tie it to profitability. If you can get away with tying it to, let's say, top line revenue, at least that you can kind of control with a higher degree of certainty. So for what it's worth.
No, that's really good. Let's talk about the process of selling, meaning, I've done it private party where it's really pretty simple most of the time. And I've done it selling to private equity where it took a long time. And like you said, we were looking at our stuff when we just kept giving them more and more information. They kept asking more and more questions. And the reality is, we are not that a real sophisticated seller compared to a team of private equity people, like combing through our financials and whatnot. Like the extremes, a simple business sale compared to like private equity, just to like from the audience who may not be aware of either. They maybe never exited a business. Like, what are some of the big differences with those two?
Yeah, I mean, I would add a third actually, which is like an individual investor buys a business. Oftentimes, they are the least sophisticated buyer. Oftentimes, in a funny way, diligence actually is easier because they just don't know what to ask for. So in a lot of times, if you're selling to an individual investor, they usually will get an SBA loan in the United States, or they'll have some sort of financing from a bank, and you'll end up usually providing some sort of financing in the form of a vendor take back. And so that, from a diligence perspective and a process, is usually relatively simple. Again, I agree with you. Private equity groups tend to be a much more difficult buyer from the standpoint of they're scrutinizing your financials to a high degree. And probably even more difficult would be a strategic, because a strategic acquirer is a large company that's making the decision to buy a business because it's worth more in their hands. And they've got a consideration of the reputational risk associated with buying your business, right? So if you're selling to fill in the blank, Fortune 500 company, Procter & Gamble, Ford, Tesla, Apple, Google, like they've got to think about, okay, we're buying this company, but there's huge reputational risk for us in buying all of this business. That's not the case with a private equity group. The private equity group will generally have a demand for what's called pre-diligence. And the way I think you can really defend yourself against being taken advantage of by a private equity group is pre-diligence. So pre-diligence I learned about through a guy named Michael Houlihan, who still sold Barefoot Wine. Do you know Barefoot? Michael and his wife Sherry told me about this. I love this example. They believe in something called pre-diligence, right? You've heard of due diligence, where you scrutinize all the books after signing a letter of intent. Pre-diligence happens before that. And it is where you put together every possible answer to every conceivable question your acquirer is likely to ask you during due diligence, and you put it together neatly into some online file or data room, or in the case of Houlihan's, a binder. And And so when they went to sell Barefoot, they put together the pre-diligence. And I said, why did you go through all that trouble if you weren't sure you were going to sell? And he's like, we wanted to sell to E&J Gallo, the largest winemaker in the country. We knew that we would have one shot, and we wanted them to take us seriously. And we knew that if we got the business dressed up for the dance, if we looked serious by putting together the entire pre-diligence package in a very professional manner, two things would happen. Number one, E&J Gallo would have the answers to the questions and make due diligence a breeze. But arguably more important, number two, we would send the signal to E&J Gallo that we were going to sell our business. And if it wasn't going to be to them, it was going to be to the next largest competitor. And that's the beauty of pre-diligence. When you rock up to a private equity group and you've got it all put together, they're going to go, wow, these guys are really professional. This is amazing. And oh my gosh, if we don't buy this thing, our competitors will. And it really sends the message that you're serious. So I'm a huge believer, thanks to the Houlans, of pre-diligence.
I really like that. I didn't even think about the reason why, right? I mean, when you were going there, I was thinking it because that they would be able to fix the things that need to be fixed and present the right way when the time came to present. But just the psychology around it, that makes a ton of sense.
Yeah, it really does. In particular for private equity groups, because they're seasoned deal people, right? They know what a really tight data room is signifying to the market, right? And they're smart guys and gals.
A data room. Explain that for anybody that's never had to do that. And then when it's too small for, like, when is a business too small to do a data room when they're getting ready to sell?
An online data room is effectively a cloud-based file sharing product that allows you to upload all of your private documents associated that a buyer might be interested in seeing. So you'd upload like your financial statements, your lease agreements, and so forth. So clearly, it's a very confidential document, and a virtual data room is one which is protected with a high degree of security. What is interesting and makes it different than, say, just Dropbox or OneDrive is that for you as the seller, you usually can see when buyers log into an online data room, and you can see what files they download. And so it allows you, if you're running a process with 8 or 10 potential buyers, you can quickly see which buyer is most motivated, and therefore that can inform your negotiation posture. You can also see what they're looking at and which files are clearly interesting to them. And it just gives you a clue as to where their interest lies as it relates to your business. So that's an online data room. Some people do it in the form of physical binders, but these days it's almost always in an online data room.
Can you go back to your book, Built to Sell? What are some of the key takeaways? What are some of the things in there that the readers just really resonated with that you want to share with the audience? And then I want to do the same thing with your newest book.
Yeah, I mean, look, I think the kind of theme of Built to Sell is where we started this conversation, which is how do you create a business that can thrive without you? In the case of the protagonist in the story, it's written in a story format. There's a guy named Alex Stapleton who runs a marketing agency where he's got lots of different projects, and he's got a doing pretty well, making some good money, but sort of feels like he's running on a hamster wheel. And the biggest challenge is he can't get employees to do the work because he's selling a broad set of products and services. And the problem with doing that is that employees often thrive on repetition, whereas entrepreneurs thrive on the new thing, right? And the shiny ball. So the challenge is you reach a threshold very quickly. In the case of Alex Stapleton, it was like $1.5 million in revenue, where he just couldn't continue to grow much further because it was too dependent on him. And so he went through the process. And I think this is one of the key themes in the book, is to basically stop selling some things and go from selling lots of things to a few people and doing the exact opposite, which is to sell a few things to lots of people. And he started to specialize, niche down. And then the second step, in particular for, I know a lot of your listeners, Erik, are service-based businesses. The second step is really productizing the service. So that's what we talked about before, this idea of creating your service to look like a product. And those are a couple of big themes that that make up Built to Sell and make it sort of the first step in the process of building value.
How would I do that in the roofing company? So I'm building Mighty Dog Roofing as a franchisor. We are going to bring on 40 new franchisees this year. How would I productize the service-based business for the franchisees? Like, what advice would, from what you've seen, the podcast where you've interviewed so many incredible guests, like what advice would you have for me as I'm building Mighty Dog Roofing?
Yeah, look, I think you want to focus on a specific niche, and that could be like where you, I think, run into trouble is you start saying, okay, we're really good at residential homes, 2 stories, 3,500 square feet or less. Great. You go about your life and most of your deals fit that parameter. And then an industrial building says, hey, Erik, I saw your sign. We've got a 6,000 foot building. We'd really love a new roof on it. And you're like, oh yeah, that's great. That's like 3 times more per building than I get usually from a residential. I'm in it. And instead of being able to kind of just cookie cutter replicate your business model, send the same team to go do it, now all of a sudden you're into, oh, it's commercial insurance. Oh, I don't know anything about commercial insurance. Oh, it's a different material. I got to deal with different zoning. Oh no, there's a union involved. I didn't know there were union. Now all of a sudden you're way out of your depth. And the only person that can do the deal is Erik, because you're the one whose name's on the door, the industry expertise, and it all stops with you, right? Whereas if you just stick your niche, 2,500 square foot homes, you got 3 tiles to choose from, you crank them out, you get to hire people, you get to hire and train them to do the job. They get really good at doing the job. You get satisfied customers because the people on the roof are doing the job well. Satisfied customers create recurring revenue or word of mouth, and you create this sort of halo effect. Whenever you go outside of the norm, and again, it's very tempting, right? We're like, bigger's better.
Oh
right?
yeah. We're like squirrel.
Yeah, exactly. And of course it sounds great. And short term, it is great until you realize what it does to you and your lifestyle and ultimately the value of your company.
Yeah, that's great advice. And we're going to be we have a brand called Horsepower Brands, and we're going to bring multiple franchises under that cover and Mighty Dog is just one of those brands. But it's so tempting to just make Mighty Dog Roofing a bunch of different things, or have a company that's heating and or HVAC and electrical and plumbing all in the one. But they're really separate things, and I see the best franchises kind of separate each of those deals, and that way the franchisees can focus, because it's ultimately you get into a franchise so you can just focus. And I like models that are really simple, and you have replicatable systems that franchisees can just go in and execute. So that's really good advice. You said something, and we've got to go. How many buyers look at the online reviews and the Yelps and all of the reviews? How much of an impact does that really have at the end of the day?
It can have a big impact, in particular in a retail environment where those things are a big driver of traffic, right? So an acquirer is just going to want to know, how are we going to win customers when the entrepreneur leaves? And certainly Yelp and reviews like it are going to be important, in particular in a retail context. The other thing that we spend a lot of time talking to customers about is this idea of the Net Promoter Score, because acquirers are in many cases using NPS or Net Promoter Score as a way to compare and contrast businesses in different industries. So Net Promoter Score, you can Google it. It was developed by a guy named Fred Reichheld, but it's a way to kind of measure the level of satisfaction among your customers in a sort of apples to apples way. And businesses that have a high Net Promoter Score are very likely to continue to grow quite quickly.
I like that. That's a little gold right there with Net Promoter Score. And you don't have to be a massive business to be able to do Net Promoter Score and just start tracking it yourself, do you? Okay. Last thing, the art of selling your business, winning strategies, and secret hacks for exiting on top. What do you want the audience to know about that book? They should go out and buy it now, but what is it that you want them to know before they go buy it?
I think that the value of your company is in the eyes of the acquirer. And I've now interviewed more than 300 entrepreneurs, and thank you, Erik, for being one of those. And I've basically seen that there is a cohort of entrepreneurs like you who seem to punch above their weight when it comes to selling. They seem to get multiples for their companies that are disproportionate to what would be a standard multiple for a business of their size. And what I try to do with the book is distill those hacks and best practices into a formula that any entrepreneur can follow, a bit of a field guide, if you will. There's 3 sections, and it really kind of tries to give you and demystify the process. So it's really an amalgam or distillation of the interviews I've done with people like yourself, and trying to learn from them. So I think it'll be helpful.
John, I love your podcast. How can people find the podcast, and how can people find you?
builttosell.com. And you can find the podcast, the books, my social stuff. So just builttosell.com.
Everyone, check it out. John is amazing. He's interviewed some amazing people and some average people too. But you got to check out the podcast. It's one of my ones that I listen to a lot. I'm around a lot of successful entrepreneurs, and it's one that they quote. And when I was on it, they're like, "You got on Built to Sell. How did you do that?" And I'm like, "I don't know, but I did." So John, thanks for coming on Franchise Secrets.
Thanks, Erik.
Thanks for listening to this episode of the Franchise Secrets Podcast. Whether you're watching or listening, please make sure to subscribe to my YouTube channel and to whatever channel you're listening on. If you want my help with anything from buying a franchise to franchising your business, please visit franchisesecrets.com.